Hi, and welcome to Random Rogers Big Picture for the week of December 14th. Special Winter is a Comin' edition. We're going to get dumped on here over the next few days. A lot of snow based on the weather. A foot or two of snow on the ground with no place to go. That's pretty good. Anyway, a couple of things on the agenda this week. One, just the stock market in general. And then two, I just want to touch on one aspect of the Bernie Madoff situation. So first up, with regard to the stock market, early Friday morning, there were a slew of comments that came in when it looked like the market was going to, puke down, expressing some real concern, and the market ended up rallying a little bit on the day. I wrote a post Thursday night to just auto-publish Friday morning because I had to get cracking very early to get down to Phoenix, but I jumped in there with a quick post just to say, this is not the time to freak out. When has panicking ever been the right trade? And for the Friday anyway, that turned out to be right. Go figure. But a thing really to stress on, and this is something where, after being incorrect about the magnitude of the bear market, I was right about one coming, wrong about the magnitude. So discount what I've then been saying in whatever manner you think appropriate. But basically, I've been of the opinion for a while that in terms of price, the bottom is about in, that we're not necessarily going to go higher into a new bull market right away. I do think we're going to have a massive feel-good rally and then come back down again. I can see that sort of a pattern, which I don't remember who coined this phrase, but as being a stumble along the bottom. And so what that means is, if that is in fact correct, and for so far it is, and keep in mind this is obviously not an original thought, but what this means is that, market's going to go up. Some people are going to feel, okay, maybe it's looking pretty good. And then there'll be some sort of news, or maybe even no news, where the market comes puking back down. And the thinking is that this news that would send it puking down, whether it ends up being something with the automakers or something else, that it's not going to violate the low that's already made, at least not in a way that, when looked back upon, anyone would consider meaningful. And so that means there's going to be plenty of more times, or again, if the thesis is correct, that there are going to be plenty more times where you get nervous, if you're prone to get nervous at all, that you get nervous by news or by the market's reaction to news or what have you. That is what a stumble along the bottom, if that's what is going to happen, that's what it's going to feel like. So you might as well get used to it. And if we end up staying in the same, ping-ponging between 8 and 900 or 750 and 950, whatever, and that's what we keep ping-ponging between, I don't view that as a real big hardship. It's just something to endure, wait through, and then it'll end. And when it ends, then, move on with whatever it is you want to do. If you're going to give up investing, well, the time to do it is after a feel-good rally, when you, in fact, feel good. Not now, not when it's down so much. It's going to come back. It may take longer than anyone likes or hopes or expects. It's a different issue, but it will come back. And, the best thing now, if you took no defensive action, the best thing now is to wait it out. If you did take defensive action, hopefully you did a little bit of buying here and there. I haven't done much lately because it's been ping-ponging in the same area. But, hopefully you've kind of figured this sort of thing out and you're not reacting with emotion the way some of the earliest Friday morning comments expressed. That is, when has it ever been right to panic? I don't believe that that's the right thing to do. Okay, next issue, the Bernie Madoff thing. It's a little confusing, but, he admitted to it. Apparently, based on how it's being portrayed, he admitted to it being a Ponzi scheme, and there's no money left, and I guess they supposedly had $17 billion now, and based on what they've returned to people, it all adds up to $50 billion. That's I haven't read any news stories. I've read just a couple of short snippets on Seeking Alpha. The reason why I haven't read any full-length news stories is I don't really care about it. In a way, the primary effect doesn't affect the stock market because if it was never invested, then it's not coming out of the stock market. The money's gone. It was never invested, presumably, allegedly, however you say that. So if that's the case, then it's not like it's got to come out of the stock market. So on a primary effect, it doesn't impact stocks. And a secondary effect, does anyone who think they had money in this thing need to sell something to, I don't know what, balance out somehow, whatever that means. These aren't circles that I operate in, so I don't know. But if some billionaire thought they had $200 million with this guy, and now they need to sell something else to do this, for Peter to pay Paul, whatever, I don't know. But that's a potential secondary effect. There is no primary effect, as best as I can tell. But let's talk about how this relates maybe to you, how I think it relates, anyway, how it relates to me, and I believe by extension how it would relate to you. Whatever this was, even the people in it, assuming that, pretending for a second that there was nothing bad going on, there was no Ponzi scheme, it was as it was portrayed, then at a minimum it was complicated. And it was at the management and the custodianship was all under one roof, which should be a warning flag. It's a screaming argument to keep things simple. If you look back in the archives, I've never been a real big fan of hedge funds. I've never been a real big fan of do-it-yourselfers trying to replicate private equity. Funds of funds, forget about it. I've had negative posts on those. All of these complex things that are expensive, where you can't instantly and immediately know what you have, and I'll exclude open-ended mutual funds for a second, but these rather, kind of quote-unquote more sophisticated, so a step above traditional mutual funds, these more sophisticated vehicles that are complex, confusing, and expensive, I don't think you could find a post on the blog where I said something positive about them. Certainly, the vast majority of the posts has been negative. I think it's unnecessary, even for billionaires. A simple diversified portfolio, for me that means mostly, individual stocks in small weightings, a few funds mixed in there, bonds, a couple of easily accessed exchange-traded vehicles, or over-the-counter, normal corporate issues. These are the basics, and if you stick to the basics, these things are never going to affect you directly. If you have a stock if you had, what's a stock that went out of business? If you had Fannie Mae, and if you had 3% in Fannie Mae, well, that's too bad, but your financial situation has not changed. It's a screaming argument to just keep it simple. No matter how much money you have, just a normal diversified portfolio doesn't need to be particularly clever. You know how, if you've been reading the blog, and if you're watching the video, presumably you read the blog, you know how my thoughts on how to construct a portfolio. Just keep it simple and spare yourself, having to worry about this sort of thing. I think I'm running out of time, so I'm going to cut it off here. But this is a screaming endorsement to not do complex things that are expensive, that are only available to the rich and famous, literally. Hopefully that makes sense, and I'm not cutting myself off too soon. Have a good weekend.